Hello and welcome back to the Geordie Pig Investor channel, where we delve into the world of dividend investing to help you build a portfolio that pays you. Today we're diving into Aviva, the insurance giant that's quietly positioning itself for strong growth while handing out some of the juiciest dividends on the FTSE. With solid financials, rising cash flows, and a shareholder-friendly strategy, Aviva isn't just protecting your future, it might also protect your portfolio from boredom. After all, if your investments can't insure you against bad market days, at least Aviva's payouts might cover the therapy bill. Aviva is one of the UK's largest insurance, savings and retirement providers, with operations stretching across Europe, Canada, UK and parts of Asia. They offer everything from life insurance and general insurance to pensions, annuities and investment products. In recent years, Aviva has streamlined its operations by selling off non-core businesses to focus on its strongest markets, freeing up cash to return to shareholders through dividends and share buybacks. They've been around in various forms for over 300 years, so they've survived wars, recessions, and even the invention of TikTok, which frankly is more than some companies can say. Their current strategy leans heavily on being a steady, reliable cash generator with a focus on sustainable growth. If you've been thinking about getting started with investing, this is one of the easiest ways to begin. I use Freetrade, a commission-free investing app that makes buying and selling shares simple and transparent. The platform is clean, user-friendly, and you can invest in UK and US stocks without worrying about hidden fees. And right now, if you sign up using the link in my description and deposit just £50 in your account, you'll get a free share worth anything between £10 and £250. Oh, and I might add that if you're unsure what to invest that £50 into, don't worry about it. You will still receive your free share even if you don't invest that money. It's a great way to start building your portfolio with zero risk on that first step. Check out the link below and claim your free share today. Some key stats to do with Aviva are they're currently priced at £6.62. They're part of the financials industry, have a market cap at 20.14 billion, went public back in 1990 and have over 29,000 current employees with a 1-year dividend growth streak and a 5-year dividend growth rate which is negative 2.99%, so that is quite disappointing, but do have a current dividend yield at 5.57%. Year to date, the company has performed tremendously, being up over 41%. And first off, let's have a look at some potential downsides to buying into Aviva. First off, we have their sluggish growth potential. Aviva operates in a mature, slow-growing industry. Even with cost-cutting and strategic reinforcing, their revenue and earnings growth may remain modest compared to faster-growing sectors like tech or healthcare. Additionally, they have interest rate sensitivity. As a major insurer and pension provider, Aviva's investments returns depends heavily on interest rates. Falling rates can hurt investment income, and sudden shifts in rates could also impact profitability and capital ratios. We then have the economic downturn risk. In recessions, people may cut back on insurance, pension contributions or investments, which could reduce Aviva's income. Claims might also rise during tough times, especially in certain insurance lines. And you have their competitive pressures. The UK insurance market is crowded with both large incumbents and nimble digital-first insurers. With this comes the price wars and innovation pressure, which could squeeze margins. But if we have a look at the flip side and why you should consider Aviva, starting off with their strong dividend yield, Aviva's dividend is amongst the highest in the FTSE 100, offering an appealing income stream for investors. With a focus on returning surplus capital to shareholders, it's a favourite for income-focused portfolios. And like I mentioned earlier, they have their streamlined operations. Recent years have seen Aviva sell off non-core international businesses, concentrating on core markets like the UK, Ireland and Canada. This sharper focus improves efficiency and profit margins. And we have their robust capital position. Aviva maintains a strong solvency ratio well above regulatory requirements, giving them resilience in economic downturns and room to reward shareholders. But that's not all. Aviva also display a steady business model, with insurance and retirement products being essential services providing a level of stability in uncertain markets. Aviva's scale and brand recognition gives it a competitive moat, so it's a company that I don't see going anywhere in the near future, and they're just going to keep on churning out those reliable profits. And finally, we have their share buybacks and cash returns. In addition to dividends, Aviva has been actively buying back shares, which boosts earnings per share and supports share price appreciation over the longer term. So if you are a longer term investor, this is not only going to be a compelling income play, but also one where you should see capital appreciation with them having these frequent share buybacks. And now we're going to have a closer look at Aviva on Stockopedia. Stockopedia is like a Swiss Army knife for investors. It packs stock screening, financial data, charts, and expert analysis all in one easy-to-use platform. Whether you're a seasoned trader or just starting out, its powerful screening tools help you find quality stocks faster. Its stock rank system gives you a quick snapshot of a company's investment potential, and its clean, data-rich interface saves you hours of research. It's basically the caffeine boost your portfolio didn't know it needed. If you're interested in trying it out for yourself, click the link in the description down below to receive a free 2-week trial alongside a massive 25% off any package you choose. On the right hand side, we can see Aviva's quality, value and momentum scores, which then give it an overall stock rank. The quality score measures how robust a company's business is, looking at profitability, balance sheet strength and growth consistency. Value then assesses whether the stock is cheap relative to its earnings, cash flow and assets, helping pick out bargains in the market. And the momentum score tracks recent price performance, identifying stocks that are currently trending upward. And then these three scores are combined to come up with the stock rank, a single number out of 100 that summarizes a stock's overall attractiveness, essentially giving you a quick, data-driven way to see whether a company is high quality, reasonably priced, and in a strong trend. It's like having a quick cheat sheet for your portfolio. Below the scores, we can see in a little more detail what metrics are being measured for growth and value. I love this breakdown as it shows how the company compares against the industry, but then also against the market as a whole, which really starts to paint the picture. As we can see on screen for Aviva, their current PE ratio is scored pretty poorly compared to the other 21 companies in the insurance market within the UK, with them being ranked 17th. But against the market as a whole, their PE ratio is more towards the average, being 341st out of 740. And then like you can see, it shows us for the price to earnings growth ratio, EPS growth, dividend yield, and then also shows you from some further valuation metrics as well. On the left hand side, we can then see Aviva's price and how this correlates to the momentum part of the stock rank. As you can see, they've had a very strong year so far and very close to that overall 52-week high. Then if I scroll down further, we can actually see on the right hand side the different metrics used for the quality part of the company. In this section, they'll look at return on capital, return on equity, operating margins, as well as the Piastri score, Altman Z-score, and the earnings manipulation risk score. With Aviva, if we have a closer look, we can actually see that their Altman Z-score and earnings manipulation risk score are not applicable to this company, so it means we just go off the Piastri F score. For Aviva, it ticks 6 out of 9 on the Piastri F score, which means the company is in a stable condition. But if we actually do have a closer look, 2 of these metrics are actually not applicable to Aviva, which means I would class Aviva as very stable. This is why I believe it's essential to do your own deep research into a company rather than just skimming the financials. Digging deeper can uncover information, good or bad, that you might otherwise miss, and when you finally form your conclusion, you'll be able to do so with far more confidence. And then if we continue scrolling down, we can actually see the analyst consensus. For Aviva, they believe 5 people think it's a buy, 3 at a strong buy, and 4 have Aviva as a hold, with a price target around 4% below their current price. Now I'm going to dive into Aviva's income statement to see how they've performed over the past few years. One thing I really like about Stockopedia is that it shows a full 10 years of financial reports, making it easy to build a clear picture of the company's long-term performance. Something I like to see in a company is a revenue graph that trends steadily upward and to the right. Unfortunately, when we have a look at Aviva's, this does not paint that picture, with their revenue graph being very sporadic, with some years being higher and then other years being on the lower side. This isn't always a bad sign, and sometimes it can be justified if we are to look at the total operating expenses chart, as a company's revenue might be lower, but so are its expenses, allowing overall profit to grow. In Aviva's case, we can see this partly applies. Their operating expenses are much lower now compared to a few years ago. However, when we look at their operating profits, this is actually lower today than it was back in 2016, which is very disappointing to see. Then if we have a closer look at their dividend per share, although it did dip in 2019, since then they have been steadily growing it. But having said that, back in 2018, their dividend per share was actually higher than it is right now. So although it is starting to grow again and has been for the past 5 years, this still isn't a fantastic chart to see, and it definitely has room for improvement. And as I am a dividend growth investor, one of the main things I'm looking for within a company is for it to be showing consistent dividend growth. One way to see this is by looking at the company's payouts throughout the years to see if it has been raising that dividend payment on a year-to-year basis. As you can see on the chart, Aviva has been very patchy with its dividend growth. They also have a payout ratio above 100% currently, which is a massive red flag in my books. And something I also love to look out for a company is the director dealings, because they give an inside view of how the people running the company feel about its future. If directors are buying shares with their own money, it often signals confidence that the business will do well. On the flip side, large or frequent sales can sometimes hint at caution. It's not a guaranteed indicator, but it's certainly a valuable clue when building the bigger picture. We can actually see with Aviva on the 21st of March, there was a significant sell-off of over 6 million worth of shares. This might not mean much in isolation, but considering the share price was sold at around £5.55 and there's been no other notable activity over the past year, I think it adds to the suggestion that Aviva may currently be overpriced. But one way to further confirm this is to have a look at Aviva when plugging in my numbers for their intrinsic value. To work out the intrinsic value of a stock, I combine two key approaches: a discounted cash flow valuation and also a relative valuation using peer multiples. With DCF, I forecast the company's future free cash flows, then discount them back to present value using a certain discount rate to account for risk in time. This gives me a baseline value based on the business's own cash generating ability. I then cross-check that with a relative valuation, looking at how similar companies are priced using ratios like PE, EV to EBITDA, or PFCF. By averaging results from both trends, I get a more balanced and realistic estimate of what the stock is truly worth today. And when plugging in my numbers, we can see that on the worst case scenario, Aviva was priced at 640 GBX, which would be a 3% overvaluation on the current price. On my average case, they were valued at 850 GBX, which is a 22% undervaluation on the current price. And on the best case scenario, when plugging in my numbers, we can see Aviva was valued at 1070 GBX, which is a 38% undervaluation on that current price. I then use Wall Street estimates when analysing a company because they provide a broader market consensus on future earnings, revenue, and cash flow expectations, usually based on detailed research from industry analysts with access to management insights in market data. These estimates help me stress test my own assumptions and see if my valuation is in line with or diverging from what the market is expecting. It also gives context around investor sentiment and potential catalysts or risks that may not be fully reflected in historical data alone. In short, they help validate or challenge my thesis with a wider lens. And when looking at the Wall Street estimates on the lowest forecast, they believe Aviva is worth only £5.48, which is a 17% downside on the current price. On the average forecast being valued at £6.42, which would be a 3% downside on the current price. And on the highest forecast being valued at £7.35, which would be an 11% upside on the current price. Once I've calculated my intrinsic value and factored in the Wall Street estimates for an added layer of insight, I combine all of that to arrive at my final buy price. This then gives me a well-rounded, evidence-based target that reflects both the company's true cash generating potential and how the broader market values similar businesses. I also apply a margin of safety to account for uncertainties or forecasting errors, so my final buy price isn't just a number, it's a point where I feel confident I'm getting long-term value with limited downside risk. On the worst case scenario, we can see Aviva was valued at £5.94, so with 10% margin of safety, you'd be looking to buy the stock at £5.35, and with a 20% margin of safety, you'd be looking to buy the stock at £4.76. On the average case price, they were valued at £7.46, so with a 10% margin of safety on this price, you'd be looking to buy the stock at £6.71, and with a 20% margin of safety on the price, you'd be looking to buy the stock at £5.96. And on the best case scenario, we can see they were valued at £9.02, so with a 10% margin of safety, you'd be looking to buy Aviva at £8.12. And with a 20% margin of safety, you'd be looking to buy the stock at £7.22. So what does this mean for the company? Is the stock a buy right now? I think Aviva is a strong UK dividend stock with an attractive yield, a solid capital position, and shareholder-friendly approach, making it appealing for long-term income investors. However, at its current price, I believe the upside is limited, especially when considering that the financials over the past decade have been a bit patchy, with inconsistent revenue growth and operating profits lower than it was in 2016. And if you add to that the recent large insider sell-off, with the possibility of the shares already being priced for perfection, alongside the competitive, slow growth nature of the insurance industry, I'd prefer to wait for a more attractive entry point before buying. That's it for today's breakdown on Aviva. Overall, it's a solid dividend payer, but maybe not the bargain it once was. If you've enjoyed this breakdown on Aviva, don't forget to hit the like button and subscribe for more stock insights. For now, this is the Geordie Pig Investor, over and out.